Good morning, everybody. Welcome to Coffee with KPP Live, the show that's dedicated to providing you with advice for life so that you can live richly and work towards the life that you've earned. My name's Kyle Roy, financial advisor with Kentucky Planning Partners, joined with my colleague Ben Hopper, financial advisor and CFP with KPP.
Thank you for joining us today. We've got an exciting topic, I think, something that's been hot, if you will, current events, current news with investing that I think you all will enjoy.
I think so too, and it's Ben and I have been having a lot of fun talking about this show and preparing for it because there's so much going on with what's going on with Bitcoin, what's going on with Reddit, GameStop, AMC, all these stocks that people think they want to get into and they might be getting into. We're not going to be making any recommendations. Spoiler alert, no recommendations are going to be made on this, on whether or not you should buy or sell or invest in these types of speculative investments, but we're going to talk about speculative investing and effectively what that means and what it is and what's the difference between taking those kinds of risks with your portfolio versus following a tried and true investment strategy to achieve your long-term goals. And we're going to talk about emotion and how that plays a role and whether or not the trend truly is your friend until it's not.
Exactly, and this really speaks to two of the main areas that we help our clients with, and it's kind of referenced on the sheet that we use. We always give it to our clients and prospective clients, and it's objectivity and education. So we as financial advisors have 6 core values that we like to bring to our clients, and when we're objective, we're bringing in things from the outside. We're making sure that we're not always saying the same things for the same people. When you're objective, you're taking all the information objectively and really assessing it to give a good recommendation. Like Kyle said, we're not giving recommendations today, but being objective and providing the education for these topics we think is very important.
And frankly, it wouldn't be responsible to give a recommendation specifically for an individual because we don't know you. We don't know who's watching the show. And you really shouldn't invest in anything until you know why you're doing it and how it's going to be, what objective you're trying to hit for yourself. So what we're going to do is talk first and foremost about trends. Okay, I grew up in Massachusetts. I grew up in Cape Cod. My father is actually a landscaper in Hyannisport. He's actually been cutting hedges in Hyannisport for 50 years. 50 years. And if for anybody that's been to Hyannisport, you probably know that that's where the Kennedy compound is. And I actually grew up landscaping the Kennedy compound. It's a beautiful place. If you ever get up there, please, please, please do it. And recognize just how perfectly cut those several hundred-yard hedges are, because my father and stepmother do an extraordinary job out there, and it's just an awesome place. But why do I bring up Hyannisport and the Kennedys in lieu of a conversation when it comes to investing? Many of you may be aware that Joe Kennedy Sr. in 1929 actually shorted the stock market before the crash, and it made him millions of dollars, built tremendous wealth for his family. And the story goes that he shorted the stock market because his shoeshine boy was giving him stock tips. Now, the shoeshine boy could have been the most brilliant shoeshine boy on the planet, but Joe Jr. said, quite frankly, when the shoeshine boy becomes a stock expert, that was his indicator that the markets were frothy. And throughout history, we see that there have been periods in time when it seems like everybody's an expert. And when everybody's an expert, or everybody's got an opinion, and everybody's trying to ask what the hottest stock tip is, that is a historical indicator, perhaps, that the markets are frothy. Or it could be an indicator of a bubble. We don't really know, but that story has proved itself time and time again to be a really good indicator of whether or not the markets might get a little frothy, and we might be seeing that now.
That's right, and nobody knows the future. We don't have a crystal ball. You don't have a crystal ball. All we can do is look back on the past and see what's happened and try as best we can to look out the front of the windshield. But we as financial advisors and investors, when we're talking with clients, quite frankly, that's a very hard thing to do. So,
yeah. So what's the number one question we've been hearing lately, Ben? What is everybody asking?
What is Bitcoin? And quite frankly, it's been hard for us to get a straight answer. We've been talking with all the companies we work with in our model portfolios, all those money managers that we talk to. We've been asking that because we want to start to hear repetitive things and repetitive phrases. That way we can bring these conversations to light with clients. And so what we found is that it's hard to get a straight answer. Whether it's a blockchain technology, whether it's a ledger of transactions, whether it's just a virtual currency. Everyone leads with something different when we ask what is Bitcoin. So that's been the number one concern for us, is that no one can tell us what the heck it is.
And we've been asking some really smart people. So every week at KPP, we have partners from money management firms, the largest names in the industry, global firms that manage billions of dollars that we partner with. And to Ben's point, we haven't gotten a straight answer on what Bitcoin is. And we're about to tell you what Bitcoin is. It's not what you think, but we know that Bitcoin is highly speculative.
That's right.
Highly speculative. So what we wanted to do is talk a little bit about the difference between a traditional investment and a speculative investment, because Bitcoin is speculative. If anybody tells you that they know what it's going to be worth in 3, 5, and 10 years, they don't, because we have no idea. So Ben, what's the difference between a speculative and a traditional investment?
Good question. So traditional investments, you can think of, we talked about it on the show for a number of weeks now in the past. You can go back on our Facebook page and look at past topics we've talked about. But when you think of a traditional investment, you're going to be putting your money into companies that have proven themselves to be solid companies, proven companies that make up the American economy or make up the international economy, companies that might be profitable or might be high growth companies that maybe don't have earnings right now, companies that pay a dividend or companies that don't pay a dividend. There's all sorts of different aspects of a stock and of a company, but traditional investing says that you're putting your money in something with a proven track record. The stock market's been around for over 100 years, right?
Mm-hmm.
So when you think about a speculative investment, by definition, that means something that isn't proven, that doesn't have that track record, that is very, very uncertain. Mm-hmm. So if you're thinking about your life savings, if you're a retiree, or if you're building up your life savings, if you're a 24-year-old, should you be investing any large portion of your hard-earned money into these speculative investments? And we at Kentucky Planning Partners believe the short answer to that is no, but it's very important just to know that you should always be investing in things you understand, things that have a proven track record, and we believe in a much more simpler, cleaner, traditional approach to investing.
Yeah, and a good, to piggyback off that too, kind of a tradition. What is a traditional investment? Well, Warren Buffett years ago, and down here in Bowling Green, Kentucky, is the home office of Fruit of the Loom.
That's right.
And Warren Buffett famously bought Fruit of the Loom, I think it was about 20 years ago. Mm-hmm. And it was a great example of how Warren Buffett invests, in that he always said he only buys things that he understands. And he understands T-shirts and underwear, right? Everybody wears T-shirts and underwear. And Fruit of the Loom is a company that's been around for a long time. Companies like Ford Motor. We know what Ford Motor Company does. Mm-hmm. They make great trucks. Right here in Louisville, by the way. Right here in Louisville, Kentucky. They make great trucks. And you understand Steelcase makes furniture, and you understand that these companies, that if you know and you're wearing a suit or a watch or driving a car and you're investing in those companies, there's something that you know that's familiar to you. And that's more traditional. Whereas Bitcoin, for goodness sake, it is speculative. Could Bitcoin go through the roof? Quite frankly, from where it was years ago, and you could have made a lot of money in Bitcoin. But quite frankly, it is something that nobody really can give a straight answer. And the one person I spoke with said, "I just am investing in Bitcoin so that I can learn how it works." That's the definition of speculation, right? Purely right there. That's speculation. So now let's move on into what else is hot in the market. And we hear about Robinhood. and we hear about short squeezes and what's that all about? So let's talk briefly about what's happening there, because that is definitely another trend. It's another fad that's happening right now. Do you have any comments on that?
I think when you bring up Robinhood, the first thing that comes to my mind, and I'll let you lead the conversation on the short squeeze, but Robinhood and the apps that are out there, I think, are mainly a very positive thing as a whole. I think that although by definition they're our competition, right? We're money managers, we're investors, we're competing with them for business, but I think what they've done is they've given a start to many young people's investing careers who otherwise might not have started investing. In Robinhood and Arrow and all those apps, they let you use a very small amount of money and buy fractional shares of stocks to where you don't have to have a ton of money to get a little piece of Amazon or something like that. So I think getting that younger crowd accustomed to the world of investing from a younger age, where it's in the grand scheme of things a relatively small amount of money to them and their future, I think that's a very good thing. So, but it's important to understand their limitations too.
Yeah, and so to your point, Robinhood is effectively democratized investing. And the more people that are invested in the market, the more efficient the markets should pretty much run, right? So the more people that are buying and selling investments, the more quickly that we're going to see supply meet demand and therefore the correct price for certain securities.
That's right. There's more liquidity in the market.
That's right. Until we get this short squeeze phenomenon, right? Like, so I'm not going to go in the details of the short squeeze, but the bottom line is there were a lot of large hedge fund type people that were short the GameStop stock for more than GameStop stock was worth. So effectively, a lot of people thought that GameStop was going to go by the way of Blockbuster, didn't see a future in the company, and really didn't do their homework and realize that the value of their short positions was 40% more than the value of the stock itself. And some really savvy investors saw that and took advantage of an opportunity to buy it up. Okay? Because when you take a short position, you have unlimited loss if that stock continues to rise, and that's effectively what happened. Now, so where does this lead to our conversation of emotional investing? Where's the next GameStop? I'm going to start following this Reddit trend so that I can find the next GameStop. And you very well may. There's a chance, right? It would be naive to say that there aren't going to be some people that win in that scenario. But getting caught up in the trend, getting caught up in what everybody's talking about, to assume that you've got some secret stock pick that's going to make you millions of dollars, the likelihood of you being the winner of that trade is relatively low. Because for every one person that is buying, Lord knows how many other people are selling, right? And there's this old pump and dump strategy where people talk up a stock so that everybody gets in, and then when everybody gets in, those few people sell, and the stock falls. So that is a real risk that if you're tracing the trend and you're really not doing your homework and you're just getting caught up in the emotion, then the likelihood that you're going to lose is exponentially greater than the likelihood of profiting.
That's right. I think when you think about the GameStop scenario and all the stuff that happened there, I think to us it was alarming, quite frankly. At first, we were like, how can this happen? Maybe this is concerning if markets can be, and a particular stock can be manipulated to the point that it was, but we don't believe that that's going to be a trend that continues. We can't see into the future, but if someone were to do something like that to Amazon or Google or Walmart, Apple, you name it, it would be quite remarkable and quite unlikely. So we think that it's really a lot of noise. So whenever you're investing, when you're building a financial plan and you're going along your journey, you're always going to hear these noises and look at this, you need to be putting your money in that. And a lot of it, as to what we've said, is going to be speculation. A lot of it's going to be hot topics. A lot of it's going to be things that happen so quickly, and we as investors don't want to be reactionary to stuff like that. We need to be knowledgeable and be aware that it's going on, but we should not be following those trends and believing that it's the future.
That's right, and think about trends, right? I remember back in high school, a bunch of my friends were getting tattoos, and I'm not knocking tattoos. I'm not knocking them at all. But there was a great question that one of my friend's parents asked his son, one of my good friends. He said, "Hey, look, you can get a tattoo. Just wait a couple years, and then get it then." And my friend was like, "But I won't want it in a couple years." His dad was like, "Exactly,
It's a tattoo."
That's right, and look at what you wore back in the '80s, the '90s, right? Look at the trends that came and went, and when we think about investing, it'll be my 20th year in the industry this year, come September. It's hard to say that, hard to believe, but I've seen trends come in investing. I got in right after the tech bubble crash. There was the real estate bubble in 2008, and then after that, there was this investment called REITs that came in, and some of them were great, most of them weren't, right? And investors were piling in, following these trends, getting caught up in that elation, and only to find that when the bubble bursts, they're left stranded. And the analogy we always give is make sure that you have a plan, right? It's easy to get caught up in the excitement of what's going on today and feel like you're going to miss out. You're going to miss out on the next big upswing. But the reality of the situation is that if you maintain a disciplined investment approach, if you're working with a financial professional, we encourage people, if you want, build up that Robinhood account. That's fine. But you're ultimately going to get to a place in your life where you realize that a professional, someone to guide you there, someone to chauffeur you and chauffeur your investments to and through your retirement, increases the likelihood that you get there and that you get there safely. Because I've given this analogy. It's the driving in traffic analogy. It's the driving in traffic. I always come back to it. It's an oldie but goodie. Everybody watching this show, when you're sitting in traffic in the middle lane, the left lane's moving, what do you ultimately want to do after 30 seconds?
Move over to the left lane.
And who hasn't done it? We all move over to the left lane. Then when we move into the left lane, what happens?
The other lane starts to go faster.
Yeah, and you stop, right? And then what do?
Then we switch back.
That's what we right? That's chasing the trend. And we ultimately find ourselves not really going anywhere. Or we're getting to that place a lot less efficiently than we would otherwise. And sometimes it just takes that disciplined approach. You see the truck drivers always stay in their lanes because they're always on the road. They know that staying in that lane is the right thing to do, and they're going to get to where they're going more efficiently. And having a financial professional, having an investment manager like we do at KPP, we're that chauffeur.
That's right. And always remember that it's important when we think about these topics, remember that investing is different from gambling, right? So why is that? Not everyone believes that. Some people think that investing is gambling. If you're got your money in the stock market, then you're just taking a gamble, right? You've heard that before, but we don't believe that to be true. There's studies shown, there's data that proves that investing, when done right, when done from a diversified approach, building a portfolio, especially when you have the help of a professional, is indeed not gambling. So having that diversification, having multiple accounts that help you achieve your goals of building wealth and leaving a legacy to your heirs, whatever your goals are, that is not gambling. Being in the market is going to be a part of that. But when you think that Bitcoin's the next place to be and you're going to put 3/4 of your assets into that, then you're starting to take more of a gamble because it's speculation to our point. So avoiding trends and avoiding being reactionary is incredibly important, and being financial advisors is a behavioral coaching job as well. So we're there to educate people on these topics, but to make sure that people don't make rash decisions with their money, quite frankly.
It's beautiful. I think that's great. Speculation is gambling. It really is. You're putting your money on something that has you just have no idea. Now, you could be confident. You could be confident in your bet, but you still really don't have any idea. Now, as always, past performance is no indication of future results as well. But of course, what we're doing when you have tried and true disciplined strategies, again, like rebalancing, a process where you're vetting money managers and you're looking at make sure which sectors and style rotation and things like that are all tried and true methodologies that increase the likelihood of performance while managing the risk that you're taking in your portfolio. So, with that said, I'd close it out by effectively saying, just understand what you're getting into, right? Understand the difference between speculating and investing, between gambling and investing. Understand that the trend sometimes can work to your advantage, but try to put yourself in a position where you're going to be advantaged as opposed to be disadvantaged. And I promise you, when you let your emotions get the best of you, you're probably putting yourself in a place of disadvantage more often than not.
Great way to put it. I love it.
All right. Well, with that said, thank you all for watching. Thank you for joining. Coffee with KPP Live is a pleasure to deliver to you. The feedback we get from all of our viewers, all of our listeners is phenomenal. We can't wait to give these shows, to record these shows. And stay tuned because we're actually going to be converting them into podcasts and making them available not only on our website, but across all places where you can find podcasts. So on behalf of everybody here at Kentucky Planning Partners, I'm Kyle Roy, financial advisor. Thank you for watching. And if you have any questions, concerns, give us a call. If you're looking for financial coaching, if you're looking for a place to go and have your questions answered and speak to with respect and dignity and work toward a future that you deserve, give us a call. Our phone number is 502-394-0400. We're located on the heart of Louisville's east side on the corner of Shelbyville Road and Hurstbourne Lane. We do have the best view in Louisville, but when it's foggy like this, it's just hard to prove that. So again, thank you all for watching. Hope you have a great day. We look forward to talking to you next week.